even though I have a background in math, I graduated college as an electrical engineer. I spent 30 years as a math teacher. When I came on the board, one of the toughest things for me to do was to learn and understand the financial report. I don't know how the rest of you as board members have dealt with learning and understanding financial reports. But we have someone who knows financial reports pretty well and is pretty good at explaining it. Steve Beer, who is our pro bono accountant, auditor, everything else, and a regular featured speaker at CCC, is going to help us better understand our financial reports.
Thank you. Thank you, Ed. Thank you, everybody. So I'd like to move on to the income statement. So that's going to be Exhibit B. So there are fluctuations in the carrying charges because of non-payers. So there are vacancies and there potentially are non-payers for a time. So we generally don't see that tying out directly to the per room charge times the number of rooms when we look at the financial statement. But you can check it for reasonableness for that. In that amount that's charged every month, we have the amortization portion of the mortgage. So we're paying down the mortgage, in this case, something on the order of $50,000 a month. So we take that out here to make the financial statement more reliable on an operational basis, because we know that that's going directly to pay the mortgage, and that's not there's no offsetting expense. So that's the reason why the item for the mortgage interest and the portion allocated to capital are minuses here. They're in the monthly common charges, but they're designated for the mortgage payment, and they're designated to be put into the reserve fund. So this property is not using a transfer fee to fund. It's using a part of its monthly carrying charges to build its reserve fund. There's a benefit for the not so much for your entities, but for others, that the amount of capital gets added to the purchase price of their apartment. It's an increase in capital if they sell their apartment at a profit, but that doesn't really applicable to you guys. The abatements, I'm sure everybody knows, things like the star abatement are required to give to the cooperators, so that's the reason why they're negatives. We've been seeing in this economic situation that the surcharge revenue has been declining. I'm not sure if that's turning yet. I haven't seen it yet on any of the properties. But generally, we've been seeing that, I guess because people's incomes are down, surcharge revenue is down somewhat, so that's a tough one to budget for. Other income are always opportunities to minimize our per room calculations wherever we can find other funding that we can use to pay expenses. We don't need to get to the people for carrying charges. So what I always say is that there's only the one place for the money to come from in a lot of these properties, and it's from the cooperators. Unless we can get grants or we can increase on the rollover of apartments, basically it's going to come from the cooperators. So we'd like to break it down there for the income from the cooperators. And then we have some ancillary rent for some professional space, and the other revenue, which is a small item, just to round out the income. So the revenue is what we were entitled to on the accrual basis, as opposed to what we actually collected. So that's an important item. Same thing with the expenses. We're on the accrual basis, so it's what we incurred. So it's not specifically what we paid. So many times when people look at their Their reports, they have trouble following the difference between the cash and accrual basis. So as these buildings tend to age, we're seeing the need for repairs to grow. That's something that we all have to keep in mind, and for whatever reason, cooperators would love to see that there be no increases. And I heard a couple of comments here today that some of the buildings haven't had them for a very long time. That's a very big feat. You should be very proud for yourself, because things like repairs continue to be growing from what we're seeing. You can save money. You guys probably have talked about this at these meetings, to have repairs done internally, to have the men do it as opposed to bringing in vendors, send them to training, to have them do things that you don't have to bring in a vendor. We're seeing, trying to keep these carrying charges as a minimum. We're seeing labor at union scale. The benefits charges are going up a double digit. So it's a very difficult environment to keep the cost down. On the real estate side, those buildings with the shelter rents, remember it's only on the residential portion. So we're seeing a lot of the commercial and professional areas being reassessed. So I don't know how many others are feeling that, but that's what we're seeing on our clients. So that's an important item. All of the city's charges are growing faster than the rate of inflation. It's just a fact of living here in the city. And I think cooperators don't realize that, so it's something we need to get out to people. The winter of 13-14 was the third coldest in 50 years. So we saw a lot of out-of-budget issues, which a lot of the buildings are dealing with this year. Some of the buildings were basically, who used to always use natural gas, were totally on fuel oil for the month of January. That big difference in pricing at the coldest time of the year threw out a lot of budgets. So it's something to, as an answer if people are asking the question. Insurance is going up. I'm seeing up 10%. I don't know whether it's leveled off yet. I haven't looked at the 14 to dates yet, but the budgets we've been looking at for 15, we're still going up a fair amount. Seeing a lot of swings in workman's comp insurance. I don't know whether you guys are seeing it, but has not been a steady expense, I guess, because of claims, changes in rates. So we like to say plan on expenses going up 3.5% a year on average. So that would transpose to a 3.5% increase, and a lot of cooperators really don't want to hear that. We talked about internal controls before. So one way on repairs to keep costs minimized is good controls on inventory. That's a really tough one. Inventory systems are expensive. Purchase orders are not always attached to the bills when we're doing it. When we ask for the inventory records, we're not seeing the counts. So just a heads up if that helps. So on the expense side, it's really straightforward that these are just expenses. The important part is when you get into to the middle of the sheet is the net of operations before other items. So you need to, for the requirement to comply with GAAP, you need to get to the bottom line, which is deficiency of revenue over expenses. But the one item we already talked about that's a big item in there, which is irrelevant to our operations, is depreciation and amortization. So as you can see, that makes a big difference in the numbers. So we do a subtotal before other items of the operational standpoint as to where we were. And that's really the important item to bring down, to be able to show cooperators that we're basically operating at a break-even or a surplus. We bring down the amounts that came from capital from above because it makes sense to, you still have to take them into income, and it makes sense, as I said, to take them out of operations. The bad debts, we try not to charge to operations if they're not required. If there can be some old items, we'll put it here. And mortgage prepayment penalties are deductible and can pass through as a deduction to the unit owners on their year-end tax returns, so we try to put it through that item as a separate line item and expense it. So as I was saying, it was a great lead-in, Howie, about the accrual, is that this is on the accrual basis. It's a very big change from the changes in the cash. So when we get to the cash flow, we can look at that a little bit more. I'm just going to touch on the shareholders' equity. Generally, here you can see we're just keeping track of the original capital stock, the results of operations from the deficit, from depreciation for the couple of years. The important item is the additional paid-in capital that we're putting aside about $100,000 a month to amortize the mortgages. And we're getting an additional $500,000 a year from increases in contributions from new cooperators versus the old cooperators. So there is a long-term funding vehicle here of about $500,000.